Okay, let's go.
You spend months carefully building a trading account, following your strategy, accumulating small wins, and then, in a matter of hours, it collapses to zero. When an account blows up, the immediate instinct is to blame the strategy, but the underlying math usually remains sound. This data illustrates how a system with a 55% win rate and positive expectancy results in a total loss when execution fails. Relying on discipline is generic. We must examine the clinical data of the nervous system processing financial trauma. The data points to three distinct biological blind spots: the grief pathways, the neurochemical misalignment, and ambiguity paralysis. The brain is a biological machine, hardwired to protect you. It processes the rapid volatility of the market using ancient survival mechanisms. Achieving consistent profitability requires mathematically mapping these biological responses and deliberately overriding them. Clinical research confirms that a significant financial loss activates the same neural grief patterns seen in physical bereavement. The brain views the blown account as a genuine visceral loss. In 1969, psychiatrist Elizabeth Kubler-Ross identified a standardized sequence of stages that people move through after a significant loss. This timeline charts those precise grief stages directly onto the hours and days immediately following a failed trading challenge. The anchor stage manifests as externalization. You blame the spread or market manipulation because taking full responsibility for the loss carries a heavy cognitive load. Bargaining follows, leading to surface-level tweaks to your strategy, like switching pairs or changing session times, as a way to avoid a deeper reckoning with execution errors. Beyond these emotional stages, we must examine the specific neurological state the brain enters immediately following the loss. Researchers at the University of North Carolina documented how the brain processes this type of failure, identifying two distinct biological states of rumination. The first state, intrusive rumination, is involuntary. The brain replays the lost trades in a chaotic, unstructured loop while you're in the shower or trying to sleep. Recovery requires transitioning to deliberate rumination. This is an intentional process that forces those thoughts into a linear, structured progression of specific questions. In practice, this means using a journal for a strictly defined period to analyze exactly what happened, removing the element of self-punishment. Adopting this structured analysis serves as a mechanical reset for the brain's involuntary trauma loop. Without manually forcing this transition into deliberate rumination, the cognitive baseline remains compromised, leading to the same errors in the next challenge. A quantitative reality is that a 40% win rate can mathematically yield higher returns than a 90% win rate. Yet, traders relentlessly chase the higher win percentage. Your brain prioritizes neurochemical comfort over mathematical expectancy, actively optimizing for the sensation of being right rather than actually maximizing your financial profit. Every closed winning trade on the left, regardless of its financial size, delivers a discrete hit of dopamine. The social media environment of the trading community exacerbates this. Posting an 85% win rate gets likes and validation, while the actual profit factor often goes ignored. Being right most of the time creates an illusion of control. It makes the operator feel they have mastered an inherently chaotic system. Prioritizing those dopamine hits trains you to focus on a metric that actively hides whether your account balance is actually growing or shrinking. This biological preference for winning is compounded by Nobel Prize-winning research regarding the asymmetrical way the brain processes gains versus losses. This scale visualizes a specific finding. The psychological pain of a loss is felt roughly 2.5 times more intensely than the pleasure of an equivalent gain. Because the penalty of losing is so intense, the brain seeks out multiple small trades just to avoid the pain of a single loss. In live execution, this manifests as dragging a take-profit line down to secure a small win. Conversely, when a trade moves against you, you push the stop-loss further away to indefinitely delay the pain of realization. These constant micro-adjustments dismantle the risk-reward ratio your strategy relies on. Execution adjustments made to protect your psychological comfort function as a mathematical concession that destroys long-term profitability. If trading has felt harder to navigate recently, it's because geopolitical chaos has increased market volatility and introduced complex new variables. Traders are attempting to process tariff announcements that reverse in days, inflation data that contradicts itself, and active military conflicts affecting safe haven flows. High-level legal and trade law rulings are unexpectedly hitting the newsfeed, reversing trends and disrupting energy sectors. Academic findings confirm that financial markets now react more violently to the threat or rumor of an event than to the actual event itself. This environment forces the brain to deal with a critical psychological distinction: the difference between risk and ambiguity. Risk occurs when you don't know the exact outcome, but you know the probabilities. Ambiguity exists when both outcomes and probabilities are completely unknown, leaving you operating blind. When starved of probabilistic data, the brain's predictive modeling system fails, defaulting to a freeze response. Panic closing a position during a headline spike reflects a biological system reaching its processing limit. Retail traders operate in an emotionally taxing environment within a macro landscape designed to induce ambiguity. Bargaining after losses, chasing win rates, and freezing during volatility are natural neurobiological functions reacting to unnatural stressors. Successful trading psychology focuses on recognizing these specific hardwired biological triggers in real time, exactly as they happen. The objective is to apply mechanical, structured processes to override those impulses as they occur. Mastery of the market requires accepting that your brain's natural optimization for comfort is the exact mechanism destroying your edge.